If you know how the world financial system works, you know the game that you're playing. And if you don't know the game and the rules that we're playing by, you're going to get slaughtered. You are going to get slaughtered. Ever since the Federal Reserve was born, we have been living under a lie. In order for us to maintain the levels we've got and to maintain the prosperity, Obama has to be twice as far in debt when he leaves office than when he came in, or the whole thing is starting to collapse. The Federal Reserve, they're buying bonds directly from the Treasury. This is quantitative easing, they're calling it. And that means there's an emergency going on. I could see that there wasn't anything in history as far as finances go that was as much of a sure thing as gold and silver accounting for the expansion of the fiat currency supply. There's absolutely no chance in hell that this won't happen. Right now it takes about $15,000 to $20,000 an ounce gold. I believe that there's going to be deflation first, and then all of the world's central banks will start printing like crazy to get us out of that deflation, and Ben Bernanke will be leading the charge. And you can't have a debt that is 10 times the size of your economy. It's not possible. Everything comes to a screeching halt first. I got to show you that the world's stock markets and real estate bubbles have to continue crashing, because all it is the market trying to seek fair value. It's trying to seek equilibrium. This is what the markets do. It is their job. Basically, you know, our entire currency system is imaginary. It doesn't really exist. It's just that we're all dreaming the same dream. If anybody chooses to wake up, it's over with. Thank you very much. I'm Mike Maloney, author of the best-selling book on precious metals investing, Guide to Investing in Gold and Silver. It's part of the Rich Dad series that Robert Kiyosaki started. The original book, Robert Kiyosaki says, write a book. No other instructions, write a book. And so I started writing this book, 2.5 years of research and writing, probably 30 hours a week, every week for 2.5 years. It's a very well-researched book. The one thing I really worry about is perpetuating misinformation. I want to be accurate, and then I try and boil it down and make it real simple. I read all these books by economists like Milton Friedman, Murray Rothbard, Ben Bernanke. If you get a chance to read some Ben Bernanke, don't. He's a horrible author, just horrible. They're all trying to write over each other's heads and impress each other. And by doing so, they make economics sound so complex that everybody thinks, well, I can't understand economics. It's really simple. Economics is very simple if you boil it down to its essence. And it's not that difficult to understand, and that's what I try to do in my book. For the people that have not read my book, about 75% of it is not about investing in gold and silver. It's some history of money, and then how the global economy works and what could potentially happen. You know, so it's where we came from, where we are today, and what could potentially happen. By the way, I really couldn't care less about gold and silver. I don't want gold and silver. It's just in its cycle right now. It's a stupid lump of metal that doesn't have cash flow or spin-off dividend yields. And so I don't want gold and silver. It's just that right now I don't want anything else. They're just in their cycle right now, and they're going to be outperforming everything else, in my opinion, from all of my research. And you're going to be able to buy a whole lot more other stuff, a whole lot more real estate, a whole lot more stocks, a whole lot more oil wells, farmland. All the true wealth is in the buildings, the businesses, the farmland that's out there. And people get this picture in their head that if there's this economic disaster, if there was some sort of collapse, that it's going to be like this nuclear wasteland afterwards. It's not. All the buildings are still going to be there, the apartment buildings. It's just that they're all going to be on sale. The problem is, when investments are on sale, nobody buys. The public comes charging in and they chase investments after they're going up. Gold and silver get hot whenever they're going up, and as soon as we see them take a dip, it's like sales turn off like a light switch most of the time. And I don't want anybody to get slaughtered. I really don't want these bad things to happen. I just think that all the evidence is there that what our leaders have done to the economic system is going to cause these things to happen, and it's inevitable. And I am trying to warn as many people as possible, as quickly as possible. My company has a mission to get as much gold and silver in the hands of the middle class as quickly as possible, because when there is great economic upheaval, there is great political change. It usually goes along with it. In the hyperinflation in Weimar Germany in 1923, this hyperinflation ended on November 15th, 1923. On November 8th, 1 week before the end of the hyperinflation, Hitler's stormtroopers pointed machine guns at the front door of the Burger Braukeller, where there was a political meeting. This is a big beer hall where there were about 3,000 people listening to political speeches. And on that night, he took the stage at gunpoint and to this literally captive audience gave a speech that would change the world. Nobody knew the name Hitler. Nobody knew who he was until he gave this speech to a newly impoverished middle class, people that were scared and looking for somebody to lead them. And here this charismatic guy takes the stage, gives them a scapegoat, and says, "I know the way out of this." The next day, those people in that beer hall followed him to try and do a coup to take over the government, and it failed. He was imprisoned. He was tried for high treason. His trial went on for an entire month, and during that month he had the ear of the nation. He was covered in every newspaper all across Germany, and the judges were sympathetic to his beliefs, so they let him go on for hours on end with these speeches. And that's when he gained power. It was when the middle class was scared. The middle class defines a country with their vote. The country, as the middle class goes, so goes the country. And so what I am worried about isn't the loss of my financial well-being. It's the loss of capitalism. It's the loss of our quality of life. It's the loss of our freedom of choice. That's what I'm worried about. And I know that there's certain people that I'm not going to be able to reach. Joe Sixpack, I refer to, the guy that comes out of his beer and football-induced coma at the very end of a bull market and comes charging in and buys at the peak. I can't do anything for him. I'm hoping that I can do something for all of you. These are wealth cycles. If you have two asset classes that are rising, you have, for instance, let's say that this is real estate on the bottom, and on the top here we've got precious metals. Precious metals in this last decade here, precious metals outperformed real estate and stocks, but everything went up. Stocks went up, bonds went up, real estate went up, and so did commodities and precious metals. Is that possible? Can everything go up? Think about it for a minute. You've only got so much stuff in society, and if you've got these three or four asset classes and everybody rushes toward one, pushing it into a bubble, shouldn't it be drawing currency away from the others? Shouldn't the others be going down? Well, they didn't in the last decade. And what's happening here, if you've got two things that are going up, if you're invested in this one down here, when you go to sell, you can't buy as much of this one. If you're invested in this one, when you sell, you can buy more of this one. They are both rising in price. This one is falling in value. When you sell it, you can't buy as much gold or food or oil. Your house is worth half as much in oil as it was. Oil was 10 bucks a barrel in 1999. So your house measured in oil has crashed. The stock market measured in oil has crashed. If you start looking at your home or all of your investments and you divide them by something else, you measure them in the price of a bushel of wheat, a pound of copper, a ton of iron, shares of the Dow, or ounces of gold, you're going to discover something. These two things that are going up, eventually, the people that are invested in this one realize that the smart investors realize that that's going into a bubble. They sell and they buy the undervalued asset. And then this trend reverses. It can't go on forever. If it did, if gold outperformed real estate forever, there would come a day where 1 ounce of gold would buy the entire planet, and we all know that that can't happen, right? So, eventually one becomes overvalued and the other one becomes undervalued, and the cycle reverses. And then it reverses again. And what is happening is they're printing currency at about this rate, and that's the reason you can't see it. People will say, well, at least my house is worth $100,000 more than it was in the year 2000, or it's worth 20% more. Well, if inflation was 40%, it actually went down in value. They'll say that, they look at the stock market, and the Dow right now is just barely above its 2000 high. It's a lost decade. Stocks have gone sideways for a decade, and we've had inflation during that time. They inflated the currency supply. So, if you start measuring one thing with another thing, so you're measuring stuff against stuff instead of using currency, what you discover is that everything is trapped in this valuation channel, where it goes from overvalued to undervalued to overvalued to undervalued again. And there's the thing that you're measuring it with is doing the exact opposite mirrored wave. The trick is, sell the overvalued asset near a peak if you can, find the undervalued asset, and I call this wealth cycles. And if you can do that, it's a road to true wealth. You're escaping that valuation channel. So here is a real example. This is the Dow measured in points. And what are points? Points are derived by the dollar value of the underlying stocks. So basically, it's points are dollars. And one of the reasons that they measure it in points is just like if you go to Las Vegas, they take your currency and they give you chips. And now it's just pieces of plastic, so you don't care. You're just having fun. So change it to points, and it's not as bad as if, well, we lost so many dollars. It went down so many points. But anyway, that's the Dow measured in points. But if you go every month during this entire graph from the year 1900 to today, and each day you take the points on the Dow and divide it by the price of gold, you get how many ounces of gold one share of the Dow is worth. And this is what it looks like measured in gold. It's not going anywhere. It's got a mean of about 4 ounces of gold, which means that the price of gold should be 1/4 the points of the Dow, and then things are sort of in equilibrium. It's fair value when the Dow is only 4 times the price of gold. But what you see here is that it goes from fair value into a bubble, 18 ounces of gold, crashes down to 2 ounces, another bubble, 28 ounces of gold, because the bubble was bigger, because they print more currency in the meantime. When it crashed, it went down to 1 ounce of gold. There was a day in 1980 where gold was 850 and the Dow was at 850 points. 1 ounce of gold bought the Dow. Conversely, if you cash out, you could only buy 1 ounce of gold with the proceeds of your stocks. And then we go into the biggest bubble in history. There is no time in history, this point in 1999, 2000, there is no time that gold was as unloved and ignored as in that time period. It was no nation's money. It had gone down for 20 years. It was the worst investment you could possibly make. Nobody wanted it. Take this. This is the price of the Dow measured in gold. Flip it upside down, and you've got the price of gold measured in the Dow. Put these two things together, and what you find is that there's a cycle here. And if you had ridden stocks up to 1929 and then sold your stocks and bought gold, and then in 1932 gone to gold, and then back to stocks, I mean, and then in 1980 go back into gold and so on. This is a road to true wealth. I mean, you're making massive gains here. I show 2 hypothetical families in my book, and one goes from $35 to $11,000 over that time period, and the other one goes from $35 to $11 million. and that is the difference. One family creates a dynasty, the other one didn't even break even. This is the gold-Dow ratio instead of the Dow-gold ratio, so you're measuring gold's value per ounce, measured in what percentage of a share of the Dow that it will buy. And what it's showing is that gold is nowhere near a bubble. It's very undervalued here. It still has to go up. The mean should be 25% or more. And in every bubble in history and in nature and in, I used to be an electronics engineer in physics, when something is out of whack, when it reverts back to the mean, it overshoots. If it's more out of whack, when it reverts to the mean, it overshoots further. So I'm expecting a day where the price of gold will be double or more the points on the Dow. This is the silver-Dow ratio. Silver has just, I mean, the gains here should be immense. This is just gold for the past decade. I just challenge anybody to go and find an index or a stock or anything that looks that good over the last 10 years. This is a perfect chart. It's very bullish. There's nothing here saying that gold, in this information that you're looking at, this is what technical analysts look at when they're trying to figure out whether to buy an asset or sell an asset. And this is saying that gold is probably going to continue rising. There's nothing bearish in that signal. This is the S&P 500 over the last decade, so representing stocks, the 500 largest companies in America, and there's gold. Here we have silver, and I recently spoke at the 8th Annual Banking Conference in Sochi, Russia. This is the big banking conference for all of Europe and Russia. And I was showing them this at the very end. They cut me off. It was really interesting. I was running out of time, and you hear this voice come over the loudspeaker, and it is their finance minister in their parliament telling me, Mr. Maloney, you've got to stop now, Mr. Maloney. They were trying to cut me off. I was presenting this information that they did not want presented at this conference, and then he comes up to me afterwards to he's got a copy of my book that he bought, and he wants it signed. Oh, by the way, please visit our table afterwards. We're giving away, these are $100 trillion bills. They're real. They're from Zimbabwe. We're giving away $20 quadrillion at my table. So come and get your 100 trillion. Okay, so what I showed here was that there was an inverted head and shoulders, and this works just as well upside down as it does right side up. You can see the head hanging. It's like this guy's hanging from his feet. This is the head and shoulders that I'm tracing out here in blue. And then you draw across the neckline and you invert that head and the predicted move. And you'll see this if you watch if you Google $10 oil, you'll see a video where he's cutting me off and I'm sort of flashing through this. I don't get a chance to describe it, but I was predicting that silver would make a big move, and guess what? That's what silver did. It doubled from where it was. This is the spot price of silver. This is the price of silver IOUs. The price of gold and silver is determined by people going, I owe you 5,000 ounces of silver, I owe you 5,000 ounces of silver, I owe you 5,000 ounces of silver, and they're handing these things out, and they're trading these IOUs on the commodities exchange, and that's what determines the worldwide spot price. Now, you can do these naked, it's called a naked short. If you don't have the silver to cover it, if you're not sitting on a pile of silver and you're writing IOUs, you can still sell them. And some big banks do this, like JP Morgan. And they'll crash a market and then come in and cover their shorts. They buy those IOUs back at a lower price than they sold them for, and they get to make the spread. They fleece the public and some funds that invest in silver for hundreds of millions of dollars by doing this, and they've done it on a regular basis. But silver fell too low this time, and so did gold. And investors that were looking for physical realized it was just too cheap, and they all had to get some, and shortages developed. And all across India, Europe, and North America, the cupboards were bare. There were 3 months where we could only get one silver product at a time, and we had no gold. We didn't have gold at my dealership for 3 months, and I deal with 4 of the world's largest wholesalers, and they could not find gold for us. People don't realize how much gold and silver there is on the planet. There are 6.6 billion people on the planet. There are only 2.2 billion ounces of gold. That's 1/3 of an ounce per person. Silver is even more rare. There's only about 1/14 of an ounce per person. That means that 14 people have to share that same 1 ounce of silver. And right now, you can get a whole lot for your currency. I'm going to take a little detour here. I did not define the difference between currency and money, and you will hear me say currency, currency, currency over and over and over again. Back before World War I, each note that a treasury issued, each dollar in existence in the United States, would say that there have been deposited with the United States Treasury $20 in gold coin payable to the bearer upon demand. The money was in the vault. The currency was a note they gave you that was a claim check, only a claim check on the money, the same as if you go to the